Oi, quick question. Where did money come from? Go on, take a second and give it a proper think, because it's not as obvious as it sounds. Most people, when you ask them, say something like this. People used to swap things. You've got chickens, I've got grain, so we do a deal. But eventually that gets complicated, because what if I don't need your chickens right now? So someone figured out it was easier to use something everyone agreed had value. Gold, silver, shells, whatever. And that became money. Seems logical. I mean, it's literally in school textbooks right now. And it came from one of the most famous economists who ever lived. The only problem is, it's a complete load of bullshit. And why should you care about a dodgy history lesson? Because the real story of where money came from and how it actually works right now, today, explains a lot. Why you're paying the rent you're paying. Why your parents' mortgage costs what it costs. Why the system seems to run one way for some people and a completely different way for everyone else. So, let's throw away the textbooks and look at the reality. That chickens for grain story, it comes from a guy named Adam Smith. He wrote it down back in 1776 in a book called The Wealth of Nations. Book 1, Chapter 4, if you want to look it up. Smith was genuinely brilliant. I mean, his ideas shaped how economics worked for the next 2.5 centuries. And in that chapter, he laid out his theory of how money must have started. People bartered. It got awkward. So they invented money to make trade easier. But there's one problem. There's no actual evidence that it ever happened that way. A Cambridge anthropologist named Caroline Humphrey spent years looking into this. Her conclusion, published in 1985, was blunt. No example of a barter economy, pure and simple, has ever been described. Not one, not anywhere. Every single study of how actual human societies have organised themselves says this thing just never existed. Let that sink in. The foundational story of where money came from. The one in the textbooks. Built on something that, as far as anyone can actually tell, never even happened. To be fair, the logic still holds up. If you've got chickens and you want grain, you need to find someone who both has grain and wants your chickens at the exact same moment. Economists call that the double coincidence of wants. It's a real problem. Smith's logic is totally fine. His history isn't though. So if we didn't barter our way to money, then what actually happened? An anthropologist named David Graeber spent years on this. His 2011 book, Debt, The First 5,000 Years, pulls evidence from history, archaeology, across cultures. And his conclusion is that the standard story of money is, in his words, precisely backwards. Turns out, we didn't start with barter at all. We actually started with debt. Think ancient Mesopotamia. That's modern day Iraq, right around 3000 BCE. Temples and palaces were already running serious accounting systems, recording debts, rents, wages, and prices right on clay tablets. Silver and barley were the units they used at that time. But here's the thing. Most people never actually touched silver. They ran tabs. The money was the record of what you owed, not a coin in your pocket. Think about how you and your mates handle it when no one has cash. You shout this round, they get the next one. Someone owes someone a favour. The group just keeps a mental ledger of who's up and who's down. That's credit. And that's what the evidence says was happening at a civilization-wide scale, thousands of years before the first coin was ever struck. Actual coins, stamped standardized metal, didn't show up until around 600 BCE. They spread fast through the Greek world, but they arrived thousands of years after the first credit systems were already up and running. And Graeber noticed something else. Coins surged during war and empire. When you need to pay a massive army of strangers spread across a huge territory, You need something physical, portable, accepted everywhere. Credit works when people know each other. Coins work for strangers. So money wasn't invented to make friendly village trade smoother. It was in large part a tool of states, accounting, tax, of war. What about Australia? Turns out we experienced that entire history in a fraction of the time. When the British first colonised New South Wales, there was a chronic shortage of official coins. So what happened? People did exactly what the historical record says humans always do. They improvised. Promissory notes, IOUs, credit arrangements. Same story playing out all over again. Then in 1813, Governor Macquarie found he had a real problem on his hands. He'd imported Spanish silver dollars, but people kept shipping them straight back offshore because silver was worth something everywhere. So he came up with something that's actually pretty smart. He had the centres punched out of every coin. One coin became two, the holey dollar and the dump. Coins that were basically worthless outside the colony couldn't leave the colony. Now that right there, that's monetary policy all the way back in 1813 in New South Wales. Jump to 1966. Australia decimalised, meaning we swapped from pounds to dollars. Then on the 12th of December 1983, the Hawke government, with Paul Keating as treasurer, floated the Australian dollar. Instead of the government fixing its value, the market decided. That was our version of a move America made 12 years earlier. On the 15th of August 1971, Nixon went on TV and announced the US dollar would no longer be convertible to gold. Up until then, if you held US dollars, you could, in theory, exchange them for gold at a fixed rate, which at the time was $35 an ounce. After Nixon's announcement, that fixed rate was gone, and the era of fiat money truly began. Now, fiat is a Latin term that simply means let it be done. From that moment, every major currency in the world became fiat money, meaning it has value only because governments say it does and because everyone agrees to act like it does. Which raises the obvious question. If money is just a story we're all going along with, who's writing it? To figure that out, we have to jump back to one specific moment in time, the exact point where the whole system was built. The year is 1694. England, under King William III, is fighting an expensive war against France. The crown is dead broke, can't raise enough through taxes, so it cuts a deal. A group of wealthy London merchants agree to lend the government £1.2 million to fund the war. In return, they get a royal charter, a licence from the Crown to operate as a bank. And that licence came with something significant, the right to issue banknotes. That institution was called the Governor and Company of the Bank of England, and it was established on the 27th of July, 1694. Now here's the kicker. That loan to the government was basically permanent. The merchants didn't want the money back. They were there for the interest. 8% paid by the government, funded through taxes on the public, and it compounded. £1.2 million at founding, 16 million by 1698, 885 million by 1815. What was built in 1694 wasn't just a bank, it was a template. The power to create the national currency moved from the sovereign, or the government, to a private profit-driven company. And the government, well, they became stuck in a cycle of permanent debt, paying interest to that company while the public footed the bill through taxes. It didn't stop there. The US Federal Reserve in 1913, the Reserve Bank of Australia created in 1960. Every major central banking system in the world traces a line back to what a group of London merchants and a cash-strapped king worked out to fund a war 330 years ago. I'm not just telling you this for the shock value, but once you see that the system was built this way on purpose, debt funding a war, private groups handed the keys to create money, once you see that, the rest of this will fall right into place. The question now is, how is money actually created today? And this is where it gets genuinely interesting and honestly, a little insane. Before I say anything else, I want to be completely clear about something. What I'm about to tell you isn't a theory. It's the official position of central banks. It's in their own documents, in their own words. Most people think money works like this. The government prints it, hands it to banks lend it out. So when you get a mortgage, the bank takes someone else's savings and lends them to you. The bank is essentially a middleman moving money around. In 2014, the Bank of England published a paper. The actual Bank of England, the same institution that opened its doors in 1694, making it one of the oldest and most respected central banks on the planet. And in that paper, they said in plain English that this is just not how it works. What they actually said is this: when a bank makes a loan, it doesn't lend out money that already exists somewhere. It creates a new deposit in the borrower's account. The money didn't exist before the loan. It literally just appears out of thin air the second you take out the loan. And it's destroyed or stops existing when the loan is repaid. The Bank of England's own phrase for this is, loans create deposits, not the other way around. The German central bank confirmed the exact same thing in their monthly report in April of 2017. And here's where it gets personal for me. I spent more than 10 years as a mortgage broker, sitting across the table from hundreds of clients. I reviewed their bank statements, their income, and their expenses. I watched loans get approved. When I finally read that Bank of England paper, the penny dropped. Looking back, I realized I wasn't just watching money move from a vault to an account. I was watching it be created the moment the loan was approved. Now, don't think this means banks have a magical wand. There are limits. They can't just dream up infinite cash because every loan has to be backed by a borrower who can actually pay it back. On top of that, banks are kept on a tight leash by regulators. They have to keep a certain amount of actual cash on hand to settle payments between themselves. And they're required to hold enough of their own funds to stay safe. A loan is only an asset to a bank if they're confident it will be repaid. If they get that wrong, they're the ones who have to pay the price. But the reality that banks create money through lending rather than just shuffling around existing deposits isn't some wild conspiracy. It's the official stance of central banks. You can go to their websites right now and read the press releases that say so in black and white. So, what does this actually mean for you? If most money is created through lending or through debt, then the total amount of money in the economy grows when people borrow more and shrinks when people pay their debt back faster than new debt is being created. The money supply isn't controlled by some neutral government body making careful decisions in the public interest. It's driven mostly by the lending appetite of private, profit-seeking banks and by how much debt people and businesses are willing to take on. So, let's look at how that actually plays out here in Australia. As of December 2025, Australian household debt is sitting at roughly $3.4 trillion. Trillion, with a T. That works out to be about $313,600 of debt for every average household. And most of it is mortgage debt. As of late 2025, the share of median income needed just to meet repayments on a median price home is sitting at 45%. And that's a core logic figure. Even after recent rate cuts, that's nearly half your income just to pay the mortgage on an average house. Here's why that hits us so hard. Over 80% of mortgages in this country are on a variable rate. In the United States, most mortgages are fixed for 30 years. So when the central bank moves rates, most people don't feel it immediately. Here, when the Reserve Bank moves the cash rate, it hits your repayments almost straight away. That whole setup means the banking system reaches straight into your back pocket. It doesn't work like that almost anywhere else. This right here is the whole game. The money in your mortgage didn't exist before you signed for it. A private bank created it the moment they approved your loan. And you've been paying interest on it ever since, at a rate that can change at any time. Decided by people you didn't vote for. Drop straight onto your kitchen table. So, let's run all of this through the pub test. Where does that actually leave us? Money didn't come from barter. That story was made up. Not maliciously, just made up. And it's been sitting in textbooks for 250 years. What actually came first was debt. Credit, the ledger, the tab. In 1694, a private company was handed the power to issue a national currency in exchange for funding a war. That template, private money creation, permanent government debt, and interest paid by taxing the public. That became the architecture of every major central banking system in the world, including ours. The money we use today is fiat. It exists because governments and institutions say it does. And most of it, it's created not by governments, but by private banks the moment they approve a loan. That's not a conspiracy theory. That's the Bank of England's official position in a published paper, sitting on their website right now. I'll link it in the description. And most of that debt-created money in Australia is sitting on top of mortgages, variable rate mortgages, which leaves us uniquely exposed to decisions made by people we didn't vote for, under a framework that even its own independent review said needed a complete overhaul. We asked the questions, we followed the evidence, and now we know. The money in your mortgage didn't exist before you signed for it. A private bank created it the moment they approved your loan, and you've been paying interest on it ever since. Which brings us to a massive question for next time. If all our money is created as debt, who's benefiting from keeping us in debt? And what happens to the system if we were to stop borrowing? I'll give you a hint. The whole thing breaks. We'll pull that apart in the next video. So, what do you reckon? Does it pass the pub test? I'm giving it 1 beer out of a possible 5. Why? Because the system itself is completely cooked. It's built on a foundation that benefits the few at the expense of the many. And it's time we stop pretending it's for our own good. What's your rating? How many beers do you give it and why? Let me know in the comments. I'll catch you in the next one. Cheers.